Okay, well, welcome to today's webinar presented by Bank First and Ansay Associates. Today's webinar, we just have a few housekeeping rules. My name is Deb Weicker. I'll be moderating for you. First, if you have any audio issues, there is a call-in number highlighted on the screen right here for you to call. Sometimes dialing in with your phone over the computer works better. Next, all attendees will be muted during the webinar. However, if you have any questions, please feel free to use the questions panel, which is typically located on the right-hand side of your desktop. We will pause throughout the webinar to read and answer any of your questions. And finally, this is being recorded, and a link to the recording will be emailed to you, and you may also find it on the Bank First or Ansay websites. Allow me to introduce to you today's presenters. First, we have Becca Thimmig, Vice President of Retail Banking at Bank First. Becca has been with the bank since 2019 and works out of the bank's Sheboygan office. She has over 9 years of retail banking and lending experience with a primary focus on mortgage lending. She earned her Bachelor of Business Administration degree from the University of Oshkosh. We also have Heather Jensen, who is a personal lines account executive and has been with Ansay for a little over 2 years. She specializes in educating her clients about the best coverages for their needs and provides her clients with a solid foundation of trust through personalized service, integrity, and a partnership you can depend on. So let's get started. Becca, I'm going to turn it over to you.
Thank you, Deb. So as part of our webinar agenda today, we're going to talk about establishing credit, budgeting and savings, paying off student debt, the importance of saving, common misconceptions for first-time homebuyers, and then also auto insurance and home and renters insurance. So please feel free to ask questions, and we'll definitely answer them along the way. So first off, we have establishing credit. And why is it important? Well, there's a variety of people, including employers, utility companies, and lenders that will run a credit check for you. Your credit score helps you prove financial responsibility and then also receive lower interest rates and better terms on any loans that you may be applying for. Many individuals that I work with, they don't have a credit score at all. Some people pride themselves on not having a credit card to rely on. However, having a good credit score and some credit history is extremely important for the future. When we talk about insurance, Heather, does having a credit score impact consideration for a home or auto insurance policy?
So a lot of people don't think that with your insurance that we run a credit score, but we definitely look at that to see how financially responsible someone might be before getting their insurance.
Perfect. So it just goes to show that it's helpful from that aspect as well. So where do you start? There are a variety of options, including secured credit cards, a major credit card, a secured or credit builder loan. Credit cards are good for establishing your credit because you can have them for a very long period of time and show responsibility when it comes to your credit score. So try not to build up debt. We've seen credit cards get out of control very quickly, so we'll want to be cautious about that as well. You don't want to charge something that you're not able to pay off. So up next, we have establishing your credit and checking your report. Annualcreditreport.com is used to check your accounts that are reporting under your name. So you can identify things that may be fraudulent activities or keep an eye on just any accounts that are showing up under your name. Medical bills are a huge thing when it comes to collections. People don't realize that they have them, and then all of a sudden the medical bill gets sent to collections and it just makes your credit score plummet. So always being sure to identify things that are under your name is helpful. And then annualcreditreport.com is a legitimate site that you can use to do that. I've also used Credit Karma as well personally in the past, but Their score is not always 100% accurate, but at least helps you track where your score is roughly and things that are reporting under your name. So what's in a score? There's a variety of criteria that's used to determine your credit score. Some of them are payment history, outstanding balances and amounts owed, length of credit history, types of credit, and then finally new credit and inquiries are grouped in one. Once a payment has been 30 days late, it shows up on your credit report for years to come. I've seen somebody that had a pretty perfect credit score and just one late payment can make it drop 50 plus points. It's really hard to say exactly what it would be because there's a variety of factors that go into it, as you can see. But the easiest way to improve your credit score over a short period of time is to pay down credit card debt. It seems a little backwards, but they say that the rule of thumb is to not charge more than 30% of your balance, or your limit, I should say, for credit cards. So if you have a limit of $1,000, I would never want to see that balance go over $350 because they're thinking that you're maxing that out and using that irresponsibly. Another thing is that regarding inquiries, this is a really common question. A lot of people are afraid that inquiries will report poorly on their credit report. However, what I've been told is about 4% of the credit score is determined by inquiries. As you can see, it's grouped with the new credit, which is only 10% of what determines your score. Deb, were there any questions regarding the credit information so far?
Yes, we have a few that just came in. So one of the questions is, people often tell me that I should get a credit card so I can build my credit, but my credit is already not bad because I had a small student loan and an auto loan, which I already paid off. I really don't want to get a credit card, but would you suggest I get one to build my score up even more? Otherwise, they were hoping that their next school loan would help build their credit.
Okay. My answer to that question would be yes, because as loans get paid off, they are no longer impacting a person's credit score positively. So like I see a lot of people that in this case, had a car loan or student loan, but once they get paid off, they don't have any reporting obligations anymore. So, having and I hate to refer to credit cards all the time, but having a credit card or a mortgage or a car loan, something that you're going to have for 2, 3, 10 years, it shows the longevity, and having accounts for a long period of time is really helpful for your score.
Great. The next question is, how do you pay your credit card? Do you send checks into the bank or you use a debit card to pay it? How does that process work?
It depends on who services your credit card. So, I use bill pay to pay a lot of my bills, which is a service that a lot of financials will offer. You just tell them how much you want to pay and away the payment goes to them. You could write a check. If you're having a credit card where you bank, you can most likely transfer the money from your checking to the credit card and make a payment. And so on and so forth. So it kind of depends on where the credit card is through.
Okay. Are there any negative effects of having a credit card and not using it for a long time?
From my perspective, I would say no. It is still showing responsible payments on the credit card is helpful. The only downfall is like if you have a credit card and you haven't used it for a year or two, it may close automatically because there's no activity on it. So, I have one that I've used for 10 plus years, and I tend to charge something every maybe 6 months to a year just to keep it active and retaining the history on it.
Okay, a couple more questions here. Will a debit card also help build your credit?
A debit card does not, because it's linked to your checking account. So a debit card wouldn't be reporting on your credit report, so it wouldn't establish any new credit scores.
Okay. Is it true that checking your score will hurt it? If so, how do I keep track of my credit score?
So anytime you check your credit score, it is an inquiry. So that can impact your score a little bit. Lenders don't want to see that you've inquired at 15 different places for new credit, although it may be for the same item. They don't want to see you applying for a car loan and a credit card and another credit card, because that might look like you're trying to obtain a lot of debt. So again, I would say like a crediting monitoring service, Credit Karma is decent, to name just one, but it could allow for you to track any large dips in your credit score. If there was something, like I said before, maybe something fraudulent that happened, or from a large amount of inquiries, you could kind of see where your score was tracking.
Okay, that's all we have for questions right now.
Perfect. Okay. So the next topic would be budgeting and savings and reasons to budget. Basically, cash flow is king. So, we want to see you establish a budget and then use it for your daily living. Establishing a budget can help you reach your financial goals, reduce financial anxiety, improve flexibility, and exposing your bad habits. You can understand where your money is going and then set priorities accordingly. So, to set your budget, what I've done in the past is also go through like 3 to 6 months of bank and credit card statements to see exactly where your money goes. Like we said, it might expose some bad habits. You might find that you spend more money than you want to in a particular category, and maybe you need to be more restrictive of where the money is going. And then also, if you are trying to establish credit and you get a credit card, you don't want that debt to snowball and get out of control too quickly. So you definitely want to make sure that anything you're charging, you have the budget to pay off on a monthly basis. This kind of shows exactly that topic. If this graph would show how long it would take to pay off a $5,000 credit card by making small payments. And then keep in mind, this doesn't factor in additional expenses that may come up and be charged to the card as well. So you can see, just for example, that first column, if you charge $5,000 and you're making a $75 monthly payment, it would take $6,100 to pay off that total expense, and 148 months, which is over 10 years. So that's a long time to pay off $5,000 by paying high interest on a credit card. So you'd want to keep that under control as much as possible. So the first step in developing the budget is to determine your income. And so it's important to remember to take your take-home pay into consideration for this calculation after any taxes or health insurance benefits and things like that are taken off of your paycheck. So the money that you take home could come from employment, birthday money, house sitting, pet sitting, or childcare, or potentially tutoring, or a side job or something like that. Next then is to determine your required expenses. So this is money that you have to spend on a monthly basis for things like rent, internet, car payment, car expenses, cell phone, food, and student loans. And also we have a little side note to remember to pay yourself. This may sound strange, but you can set up a separate savings account to deposit part of your paycheck direct deposited from your employer. This will help you save money for the future and likely just cause a habit that you really won't end up missing this money if you set aside, just say $100 per paycheck. Pretty soon you're going to have a really healthy savings account to use for miscellaneous expenses that may come up, or saving money to buy a house or something like that. So pay yourself first is a good habit to have, and something that I've always done for myself. The next part of the budget is to determine your discretionary income. So that's money you want to spend. And so that could be on all sorts of different things: coffee, clothes, eating out, holidays. So it's important, helpful to see the previous months of spending, because you can kind of see how quickly these miscellaneous expenses add up. And that's where I was mentioning you may find that you want to be more restrictive in a particular category and give yourself, maybe only a couple days of the treats, so to say, and then cut back for more savings. So why save money? Like I said before, budgets are not perfect, so if you pay yourself first and establish a savings account, you'll have a good account cushion, so that if things come up for an emergency fund, or you need a down payment for a house, you're saving for retirement or a vacation, or to just become financially independent and not be living paycheck to paycheck. Having a budget and determining your needs and your wants for the future can really be helpful and help increase your retirement savings exponentially. Another thing that we always keep in mind is that many employers offer a 401k match. So if you start with an employer and they're willing to match some of your retirement asset contribution, keep that in mind, because you don't want to let that money go to the wayside. You want to make sure that you're maximizing that and contributing at least the amount they're going to match for you. The next part of it is budgeting and paying off student debt. So when you're looking at student loans and other loans in general, you'll want to review the higher interest obligations first and pay those down faster, because obviously the less money that's going towards interest is the better. And then this will create a snowball effect. So once one loan is paid off, you can have additional funds available to pay off the next loan, and so on and so forth, until hopefully that you would be in a debt-free position. So create a plan and be consistent with that plan in your budget, and hopefully get on the right track with paying things down faster. Also, a lot of student loan servicers, as well as Bank First, offer student loan refinance options. So you can potentially look at refinancing or consolidating your student loans to get them at a lower interest rate. And then also, lastly, I just bring up continuing to pay those student loans while in deferment, because I've seen it in the past. People say, oh, this account started with $5,000 in it for one semester, and but I don't have to make payments, so I'm not right now until I'm done with school. But when you're done with school, the interest, with most loans, the interest continues to accrue on those. So when you're done with school, that student loan payment might be for $6,000 instead of the initial $5,000. So depending on what your situation is, if you can continue to make payments while in deferment, that will lessen the interest that accrues on the loan. Deb, any additional questions regarding budgeting?
We have one question. It's about savings. Would you recommend that students who are graduating in May look into a Roth IRA fund? I've heard that is a good investment account. What are your thoughts on that?
Sure. That would definitely be a question for a financial advisor. There are tax benefits to either Roth or traditional IRA. And so it's never too early to start saving for retirement because time is on your side as a young person. So if you start saving early, that money will accrue interest, which will compound and increase and increase until retirement. So you're never going to get these years back of investing. So I definitely would suggest doing that sooner rather than later. Okay, so the next topic would be common misconceptions for first-time home buyers. I've been doing this for quite a few years, and you know, unless you really do it day in and day out, don't really know all about buying a house. So that's why we're here to help. So a lot of people think that you need 20% down payment to purchase a home. But that's not really true. We have a ton of loan programs for a lesser down payment, either 3 or 5%. And then also we have down payment plus funds that are available through the bank. And so we can get grant funds up to $6,000 to assist with your home purchase. So that will go directly to the purchase price. Some other folks think that you can save money by not using a realtor. In many cases, the commission is paid for a realtor by the seller. So your agent can be extremely helpful to you finding a home, researching the home, establishing a fair purchase price and negotiating on your behalf, walking you through the closing date, earnest money, home inspection. There's a ton of steps that go into purchasing a house, and using somebody as a loan originator as well as a realtor can just have somebody to help you navigate that process, which can be intimidating for a lot of people. And then the second thing, or the third thing is that buying a home that needs a lot of renovating will be cheaper. I think we've all seen shows on HGTV for fixer-uppers and how you can take a house that looks like it's falling apart and make it beautiful and everything like that. But it really takes a lot of financial reserves to be able to do that. And also at the same time, you don't want to purchase something that would be a money pit or a lemon because you want to make sure it's structurally sound and that you don't need to do a ton because those items can be very expensive, especially when they're things like the foundation, roof, electrical, and plumbing, something that doesn't really add a ton of value to the property and is very expensive to fix. So I try to coach first-time home buyers in really finding a house that will work for them for the foreseeable future. I mean, it's one thing if you're going to replace carpeting or paint, but when you're talking about moving walls or redoing a kitchen or something like that, that can add up really fast. And just the last one is that it's cheaper to rent than it is to buy. If some of you are renting right now or looking to get an apartment, you'll probably notice that there are a lot of costs or a high rent cost in this area. And, if you plan on staying in the house for at least 5 years or so and gaining some equity in there, I would think that it would be better to buy than it would be to rent. Okay, and then so this is just a real home purchase scenario that I drew up. So this house is really nicely redone, and the list price was $200,000. I just put in a down payment of 3%. The monthly payment would be roughly $844, depending on the interest rate for the day. The taxes were very low on this property, $183 per month. I budgeted homeowners insurance for $70, and then the PMI was $50 per month, roughly. So that's when you don't have 20% down for the house, that there is this small bit of private mortgage insurance on it that would cover the lender in case of foreclosure. So then the total monthly payment is roughly $1,147, And just by what I've seen kind of in the market, I would figure that a rental cost maybe about $1,500 for this single family home. There was some things, we quoted the homeowners insurance with Heather to kind of get an idea of what it would be. Do you want to explain some of the things that were a little strange for this property?
So the biggest thing with this property was there was no basement. So that does affect the insurance in a good way because it's going to be a little less on premium because you don't have that maybe water sewer backup coverage that we would need that you typically see with a home that has a basement. Other things, this house was really updated, really nice. So, we do look at things like the year of the home, the square footage of the home. If the home is really old and hasn't been updated, that is something that the insurance could be a lot higher, or, you may not get insurance at all if the plumbing or the roof has not been attended to in a very long time. This home also was close to fire hydrants. It was close to other homes. So that definitely makes a difference as well when you're looking at how much the insurance premium will be.
Great, all things to take into consideration for sure. Okay, so then this is just a quick overview of paying off debt faster, and you could use this calculation for any loan, but this is regarding the property that I showed previously. This just goes over paying $75 extra per month. So you can see that paying that just $75 extra per month towards the loan payment took the total interest down from $109,948 in the first section down to only I shouldn't say only 94, but $94,000 in total interest. So that's a savings of about $15,000 over the life of the loan. And that's just with a $75 per month extra payment towards the principal. So you can really gain some decent headway by making higher payments on your obligations. And then also, that will just become your regular monthly payment over time. You really won't even realize that you're paying extra because it just becomes that habit in your budget. Deb, were there any additional questions that you wanted to review before Heather takes it over?
Yes, we have one question. So if you're not planning on your home to be your forever home, should you pay the extra principal? What are your thoughts on that?
Oh, okay. So I personally would still recommend it because you're going to have more equity when you go to sell the property. So there's never really going to be a harm in paying the loan down sooner. You may not pay it off before you sell it, but you're still going to, if you pay $6,000 more towards principal during the time you own it, you're just going to have that much more equity when you would go to list it for sale to use for your next property. So if you can manage it in your budget, then I would definitely recommend it. All right, so just to finish it off on my end of things, obviously your bank has lots of different products and services available to meet your needs. For instance, Bank First provides things like checking and savings accounts and other convenient services, the student loan refinances that we talked about earlier, auto and personal loans, mortgage loans with low or no down payment options, as well as the grant program that we talked about, and then solutions for small and large businesses and nonprofit organizations. So feel free to reach out to me or anybody else at Bank First with any questions that you may have. I mean, we're definitely here to help, and we've heard all sorts of scenarios and situations. So we are open to assist you with any questions that you would need. Yep, so I'll turn it over to Heather and she'll start with the insurance aspect.
All right, thank you. So we will start talking about auto insurance, and I will just start by saying that I know insurance can be very boring, so I will try to make this not as boring as possible. Our first slide is just a picture. This is some things that we see every day in insurance claims that come through. This person had insurance, good thing they did. This actually happened in our neighborhood I live in. A owner had driven through their back of their garage, damaging their home, drove through the 2 backyards and landed in the other neighbor's kitchen. So as you can see, good thing they had insurance. Both parties got taken care of. This happened to be a home and an auto claim. So really good to have insurance if there's ever a situation like this that would arise. So the biggest thing that we're going to talk about to start is, when do I come off of my parents' policy? I get this a lot asked from the child and asked from the parents. Some parents want their kid to come off their policy as soon as possible, while others would like them to stay on as much as they can. You can stay on your parents' car insurance as long as you still live with them or you go to school full time. This is true, even if you go to school out of state, if you take a vehicle with you or you don't take one with you, you can still be on their policy. There's no age limit like there is with health insurance, but you will need to get your own car insurance when you no longer live at home and as soon as you register that car in your own name. So as soon as you decide to title that car in your own name, then even if you live at home, you'll have to get your own policy. Because insurance companies only allow the cars titled in the policy holder's name. So even if you're gifted a car and your parents want you to be off their policy, you'll have to get that titled in your name. So if you get married or move in with a friend, we have a lot of people that have roommates. Can you stay on your parents' policy when you get married? No, even if you live at home while you're married, you'll still have to have your own policy. You and your spouse could have your own policy separate, but financially it probably makes more sense to pair that together. You get, multi-car discounts, things like that. And then all licensed members of the household should be listed as drivers. So if you're moving in with a roommate, even if they have their own policy, you still want to list them on your policy as an unrated driver. The reason insurance companies do this is because you may be moving in with Joe and Joe maybe has a really careless driving record. And so the insurance company wants to know that because he could have access to your cars. So they would still consider him an unrated driver. So you're not going to necessarily pay extra for that, but they just want to be aware of any risks that are in your house. So we'll talk a little bit about different coverages that you'll want to look for with auto insurance. Comprehensive coverage. This is things like theft, fire, falling objects. Maybe it's a tree that fall down and hit your car, damage done to your car by animals. If the car is older, you may not want physical damage coverage on the car. The car might not be worth much anymore. So, it might be more cost to repair the vehicle than it is to have that coverage. So you're paying monthly for that comprehensive coverage. It's a part of your premium. So to take that off once that car gets a little bit older might be a smart decision. Maybe you have a summer vehicle as well. We see this a lot. So you can actually take that summer vehicle and you can just put it in comprehensive status for the winter. So you're storing the coverage or the car, but you still want that comprehensive coverage on there because maybe you're storing it in a garage and something falls on it in the garage, you would still have that coverage. So we'll talk a little bit about collision coverage. Collision coverage helps repair or replace the vehicle if it's damaged in an accident with another car, or in this example, as you could see with the tree. So regardless of who is at fault, once you've paid your deductible, your collision coverage will help pay to replace or repair your vehicle or up to its actual cash value. So you can see in the little picture below, the tree hits the car. That would be considered comprehensive coverage. Maybe the tree fell down on the car, it was sitting in a parking lot, and then the car hits the tree. That would be collision coverage. Your deductible, you get to choose the deductibles that you have for your comprehensive coverage and your collision coverage. Your agent can definitely help you decide what those numbers could be. But if you choose your deductible and it's $100 and you have $1,000 worth of damage, you would pay your $100 and the insurance company would pay the additional $900 to get your car repaired. Some newer vehicles, we suggest putting what's called replacement coverage on there. It is a little extra premium, but what happens then if you get in an accident and let's say the insurance company says that the car is totaled, you would actually then get a vehicle replaced of the same make and model or newer if it's not available versus the actual cash value of the vehicle. So sometimes that can be really nice. We're seeing a lot of people get brand new 2021 vehicles. They put that replacement coverage on there, they get into an accident, completely totals the car, and then instead of the insurance company giving them a check for how much it's worth, they're going to replace that car for you. So that's a really nice coverage to have. So a little scenario for you. Imagine you are driving along a rural road, you see a deer warning sign. We see those a lot in Wisconsin. A deer darts out and hits your car. Which coverage would this be? So we're thinking comprehensive or collision. If you said comprehensive, you're correct. Because the collision was not caused by the driver's actions, it was caused by the deer, the damage to your car would be covered by a comprehensive policy. We tend to see comprehensive coverage. People like to keep their deductibles a little bit lower on the comprehensive coverage. It's things that maybe don't happen very often, that tree falling down, you darting into, or the deer darting into the road. So they tend to keep those deductibles a little bit lower so that if something happens that wasn't their fault, it's a lot less expensive to fix for them. So a lot of times when people are getting coverage and they're coming from other carriers, I will see what we call their UM or their UIM coverage taken off of the policy. So a lot of people will come to me and they'll say, oh, I got my policy for so cheap. And that's one of the first things that I notice is that they don't have this coverage on there. This is really, really important because it's called underinsured coverage or uninsured motorist coverage. So if you get into an accident with somebody and they don't have any coverage, your policy will help pay for that because they really don't have any insurance to be able to cover that damage. So that's where your insurance is going to come into play and help with that. This video will be saved for you to watch later. So there is a Ansay whiteboard video attached to this. I really encourage you to watch that. It explains the UM/UIM coverage in a little more detail. The other thing I notice when people come to me is sometimes their liability limits are really, really low, which yes, can make your premium a lot less expensive, but also then you do not have enough coverage when you get into an accident. So bodily injury limits typically start at like 100, 300. We call these split limits or 500 combined single limits. So the split limit just means 100, 300. We'll use that for an example. The policy will pay $1,000 or $100,000 per person and up to $300,000 per accident. So let's say your coverage was only $2,550, which is so extremely low, and a person has $100,000 in injuries that you are responsible for. The insurance company would only pay $25,000 and you would owe the additional $75,000. That's a lot of money to have to come up with. This example only had one person injured. So if we talk about 2 or 3 people that were hurt, you know, the limits are the same. It's $25,000 per person, $50K for the whole accident. So your policy would not pay any more than $50,000. If you have combined single limits, you have a total of $50,000 to spend on everything. So you can choose to spend that on multiple people, the vehicles, the whole accident. They're not going to dictate where that money goes. You just have that as a whole. So some people prefer to have that combined single limit because then it's not telling you where that premium is going to go. So really make sure that a lot of these coverages are not eliminated on your policies when you're getting quotes is really important. Other things to think about with car insurance, loaning a car to a friend or a neighbor. We all do that. It's a really nice thing to do once in a while, but just keep in mind that the car insurance follows the vehicle. So again, we'll use Joe. If Joe goes in your car, a lot of people think, well, Joe's insurance will cover this if he gets in an accident with my vehicle, but that's not the case. He gets into an accident with your vehicle, it's your insurance that would have to cover that. Uber, Lyft delivery, we're seeing a lot of this lately. If you drive for any delivery service, a lot of insurance companies do not cover that while you're working. So really make sure you're asking your insurance agent if that is covered in your policy. There was some restrictions that were lifted during COVID because we saw a lot of restaurants that were now offering delivery. So they did say if you work for a restaurant and that restaurant is now delivering food, they were allowing that, but always something to double check with your agent with. Deb, are there any questions about auto insurance before I move on to the home and the renters?
Yes, we have one question going back to coming off of your parents' plan. So what factors are taken into account for insurance when you are moving from your parents to an individual plan? What kind of factors do they take?
So they're going to look at things like your age. Unfortunately, that is a factor. You know, how long have you been driving? They're going to look at your driving records. So even if you had an accident on your parents' policy, that still is going to come over onto your own policy. Some of those may fall off in, 3 to 5 years, so you may be close to that. They're going to look at what kind of vehicle you drive. So if you're younger and you're driving like a sports vehicle, they're definitely going to put that into account. Your financial responsibility, like I said, we do pull that soft credit just to see, are you financially responsible? And then, those are really the biggest things. Age is one of the biggest ones that they look at. So that's why a lot of parents like to keep their children on their policy as long as possible if they're still living at home. All right, so we will go and talk about home and renters insurance. We'll talk about renters insurance first. The things that are covered in renters insurance are things like personal property. So the cost to repair or replace your belongings, this goes as far as your clothing, furniture, your electronics. You really want to make sure that when you're getting your renter's insurance policy that you have full replacement coverage, not actual cash value on your items. So that way, if there is a fire in your apartment or wherever you're renting, that they're going to replace those items and not just say, here's the actual cash value for your 10-year-old laptop. So they're going to replace those things with newer models, obviously. So it's much better to have that replacement coverage. Liability, repairs if you accidentally damage someone else's property, or a guest's medical bills if you are found responsible for their injuries. So biggest example we see for this is if you are responsible for a fire in your unit and it crosses over to other units in the building, you are held liable for that. So you want to make sure that you have liability in your renter's policy so that you help cover that damage for other people. Additional living expense, we can use that fire as an example again. If there's a fire from another unit and you are kicked out of your apartment for a period of time and you have to go stay in a hotel, if your residence is damaged, they're going to help cover those costs for you. Other coverages that can be added into your rental policy are things like theft. So if anything gets stolen, you do have water sewer backup. We don't put a lot of that on a renter's policy unless maybe you're renting out a home, because a lot of times you may be in an upper unit, so you wouldn't see as much water sewer backup unless you have a basement, but we do see it sometimes in bathrooms. And then just important to know, the landlord's insurance is there to protect the owner's dwelling. So his roof, his walls, all of his cupboards and flooring, things like that. But you are responsible for the belongings that you keep inside. Renter's insurance is very low premium, so it's really worth it to get that. It can be as low as $150 to $250 a year. So really, really inexpensive to have a lot of coverage. Homeowners insurance, same coverages as the rental insurance, but they definitely go into a little more detail and a lot more coverages available. They're going to look at your dwelling. Like I said before with that other home, they're going to look at square footage. Where is it located? Does it have a basement? How many bathrooms, bedrooms? They're going to want to know when the roof was last replaced, when the plumbing was updated. So again, if you are buying that fixer-upper home, it may be a little difficult to get homeowners insurance. They do it, but they're going to want to know when are those things getting replaced. They look at other structures on the property, so maybe there's a shed or a fence that you have on the properties that would be covered as well. Personal property, again, make sure that you have that replacement coverage because now you've got things such as appliances, so much more bigger ticket items in your home that you're going to want that replacement coverage for. Liability for injuries or damage to someone else's property. We've seen this happen where someone, falls down on someone's driveway because maybe they didn't repair their driveway, and now that person is, wanting to get their medical bills covered because you had something damaged on your home that you didn't take care of, and so that person is going to want to get coverage for that. Additional coverages can be purchased. We have, jewelry, if you have an engagement ring that you want to add to your policy, all of those things can be added to your homeowner's policy as well. We talked about this a little bit already with the home insurance costs. What can cause that premium to be higher? Wood stoves. Know that if you're buying a home with a wood stove, you may want to get it removed. You really want to make sure that it is professionally installed if you do plan on keeping it, and making sure that if you're buying that home, you have that paperwork that shows that that wood stove has been professionally installed and looked at. If there's a pool, you want to make sure that there's a fence or that you have the finances to install a fence, because that's going to be a really huge thing for insurance as well. Pool is a really big risk. If there's a finished basement, they're going to look at that. That adds more square footage to the home. The age of the home, like we said, roof, the plumbing, and then location. So if you're really far out with a lot of acreage, know that you may pay a little bit more in premium just because it's further for you to get to the fire station, or there might not be a fire hydrant close to you. So that might be a little more in premium. A lot of people want to keep a low deductible on their home, but we really encourage you to kind of bump up that deductible a little bit, maybe $1,000 and up. That shows the insurance company that, I might not just be putting in claim after claim after claim for these little small things that maybe I could repair myself. So having that deductible $1,000 and higher is going to help bring your premium costs down. And then one of the last things we're going to talk about is an umbrella policy. So an umbrella policy is an extra liability coverage. So it overextends all of your current limits. So if we talk about that, combined single limit of $500,000, and let's say you get into an accident and you use all of that $500,000 because maybe there was a lot of injuries there, that umbrella policy is going to kick in, and it is going to give you, we start at $1 million of coverage. It's going to kick in and then give you more coverage for, the loss that you had. So really, we start at $1 million. It can be as little as $125 a year. So really, really helpful. We see umbrella policies be used when maybe someone's being sued. and there's a lot of expenses there, or maybe there was a fatal accident where they're definitely going to want that umbrella policy. A couple examples that we've seen with some of our carriers. We actually had a 28-year-old engineer dove into a friend's above ground swimming pool. He struck his head and actually became a quadriplegic. He sued both the homeowner and the pool manufacturer, and he was awarded $10 million for that. Another example is an insured's daughter hated math class. She didn't like the teacher. The daughter made several false remarks about the teacher online, and the teacher actually sued the parents for personal injury. For $750,000 was paid out to that teacher. So that umbrella policy, if they had one, would have definitely helped cover a lot of those costs, including lawyer fees, court fees, things like that. Deb, are there any questions on the homeowners insurance?
We do have a question on the umbrella limit. So what would you recommend you base that limit off of? Would it be like your income or your assets, or how do you determine what limit is best for you?
Yeah, so definitely your assets is one of the things that you want to consider. So, if you have that home with the pool, or, maybe you have that home with the trampoline, which is also really hard to get insured, but you definitely can pay a premium to have that. How many vehicles do you have? Maybe you have a seasonal home, you have a camper, all of those types of things. Those all can be considered more risks. If you have a child in the house that is a little bit more risky of a driver, sometimes you're going to want to add that umbrella policy in, but know that if they have a very bad driving record, you may not be allowed to have that umbrella policy. But assets is one of the biggest things. So talking to your agent, finding out, what do you all have, and then basing that umbrella policy number off of that first.
Okay, and then we have one last question. For someone starting out on their own, what is the bare minimum, and what are the bare minimum insurances that you should have? If you can't get everything that you talked about today, what would be your bare minimum recommendation?
Yeah, so on auto, making sure that your limits are no lower than 100, 300, really important there. Making sure you have liability on there in those limits is going to be crucial. You can always take off that physical damage coverage, especially if that vehicle is older. Making sure you have med pay on the policy, that's important as well. And then that UM and that UIM coverage. And then on the home, making sure your liabilities, I would say no less than $500,000 for liability. Med pay as well on that home policy is really important too. And then, depending on where that home is, you can determine if you need all those extra coverages such as identity theft. Those are things that maybe you could add on later if you wanted.
Okay, great.
Yeah.
Great information. I guess just to wrap it up here, we wanted to thank everyone for joining us. You will receive an email with a link of this recorded webinar, as well as a link to complete a short survey. So, of course, we always appreciate your feedback, and we encourage you to complete the survey. And when you do, you'll be entered to win a $100 Visa gift card. So, and again, you'll find this information on our website, so if you ever want to refer back to it. Thank you, and have a great evening, everyone.
Thank you.
Thank you.